Years ago, employers began paying employees in company stock or property rather than cash. This benefit wasn't a qualified stock plan, but came with certain restrictions. This meant the employee didn't enjoy the full benefit of this earned compensation right away and couldn't be taxed. By the time the restrictions lapsed, however, the value of the stock might have changed and the courts felt it no longer reflected the services rendered, making the payment untaxable. For years, the IRS tried and failed to collect taxes on these restricted stock plans. This tax-free pay was every employee's dream. It wasn't until 1969 Congress stepped in and created rules defining how restricted stock plans were to be taxed, with Section 83 of the Internal Revenue Code. Now, if restricted stock or other property is transferred to an employee, the default rule is that no taxes are due until it vests or becomes free of substantial risk of forfeiture. To illustrate, assume your client gets a restricted stock unit, or RSU. Subject to the restriction, they do not leave the employer for 3 years. For tax purposes, it's as if your client didn't get paid the stock until the 3 years are up. At the end of the 3 years of employment, your client will pay on the then fair market value of that RSU, regardless of whether that's more or less than what the RSU was originally worth. If they leave before the 3 years, there's no adverse tax consequences. The client never ultimately received the stock, so they won't pay taxes on it. Other rules involved with restricted stock include the taxation of income from the property during the restricted period, such as stock dividends, qualified equity grants, and the famous Section 83B election. This special election flip-flops many of the RSU tax rules and increases the cost of forfeiture. Going back to our hypothetical client, if they made a timely Section 83B election, they'll owe taxes when the RSU is awarded and not when it vests. This could be a boon if things go well for the stock price, but it could be a two-edged sword if the price goes down. Additionally, if the client leaves the employer early, there's no takebacks on the taxes paid for the stock they couldn't keep. So while your client may no longer be able to avoid taxes with restricted stock and property, there aren't restrictions against tax planning for these incredible benefits.